Hey there, welcome home. Today I'm going to teach you how to save up to $50,000 on your income taxes every single year without even worrying about an IRS audit. And I'm going to teach you this by showing you that there's really 5 pillars that save the most income taxes for you. And then I'm going to teach you something else that's really cool as well. So, a mercifully brief introduction. I am known as the Entrepreneur's Tax Strategist and CPA. My name is Vern Motor. I was the creator of the Your Practical Advisor nationally syndicated radio show for business owners. And for the past 23 years, I've been helping business owners save income taxes, protect their assets, and most importantly, grow their businesses. I love working with business owners. So here's what you're going to learn during this presentation. I'm going to teach you how to plan your taxes this year so you can pay less tax now. We're going to teach you how to use long-term tax strategies without worry so you can save taxes each and every year. I'm going to show you how you can create a totally tax-free retirement. Bet you didn't know about that. I'm going to show you how to virtually eliminate IRS audit risk. I'm going to show you how to save taxes so you can retire early. And I'm going to show you a new way that you might be able to invest for your retirement. And I'm going to show you how to protect the wealth that you have created and much, much more. So, why is this important to you now? Well, most ideas we've learned, quite frankly, are dead wrong. I'm going to debunk several myths for you. I'm going to show you using math exactly what works best for you. The best time to save taxes is actually right now. So that's why it's important now. And there's a lot of traditional tax strategies out there that people have been promoting for decades that actually cost you taxes. And so I want to show you how to avoid those. And quite frankly, the faster you start, the more you can save. So you might be saying, hey, is this for me? Do I really need to stay on this presentation? Well, if you're an entrepreneur and you want real tax saving strategy that works for you, then this is for you. If you're frustrated, if you've ever wanted to organize your finances, then this is for you. If you want to retire early, and who doesn't, then this is for you. If you want to be free, emotionally free, financially free, free from worry about IRS audit, then this is for you. Look, if you've ever stroked a big check to the IRS and you want to stop doing that, this is definitely for you. And if you've ever been worried about an audit because your deductions or what you're taking, what you're not taking, then this is definitely be for you because I'm going to show you how to discover how not to worry, okay? I don't want you worrying about that. But there are a few house rules, okay? First of all, house rules. No tax protesters, okay? What's a tax protester? A tax protester is someone who refuses to pay taxes, claiming the laws are unconstitutional or not valid. Hey, look, that's gone through the Supreme Court. We know we have to pay income taxes, but we're only legally obligated to pay the minimum, not the maximum, according to the law. No tax resistors, okay? What's a tax resistor? That's somebody who says, hey, I'm not going to pay tax because I don't agree with the current administration, or I don't agree with the government, or I don't agree because it's a Democrat or a Republican, whatever it is. No tax resistors, right? We just don't deal with y'all. And no fraudulent filers. What's a fraudulent filer? Well, I call it the Wayne Brady rule. If you know Wayne Brady, he's one of the best comedians out there. He was on Whose Line Is It Anyway? He's fantastic at improvisation, and now he's the host for Let's Make a Deal, right? Wayne Brady. He had a show in Las Vegas for a long time that was called Making Stuff Up, okay? We don't make stuff up. So if you're a fraudulent filer and just want to make stuff up, you're in the wrong place. The other house rule is, look, our results aren't even remotely typical. We save our clients a lot of taxes based on strategies that work for them. Anything I show you is no claim whatsoever that you're going to save anything. You see, I don't know you, right? And I couldn't tell you how much you can save because I don't know your personal situation yet. Tax strategies are very, very personal. So don't just think that you can take this strategy and put it into place and that it'll work for you. I don't know your personal situation, but these strategies do work. So, I got out of the military in 1992. I'd spent 6 years in the military and I'd went in to help for college. So while I was in college, I worked at 2 local CPA firms. And that's when I really learned about the status quo. I learned about what most CPA firms do and what most tax preparers do for their clients. And then that's when it happened. It was 1994 in the spring. I was a junior in college. I was working at one of those local CPA firms. And then the partner asked me to meet with him and a client that I had worked on for him. So he would give me the information. I would put the tax return together. He would review it and make any changes, and then he would present it to the client. He asked me to come and meet with the client and him. And I thought, this is odd. And then I realized why he wanted me in the meeting. You see, the client owed over $10,000 in tax. Now you might think that's a lot of money, you might think that's not a lot of money, but it was over a third of what he made that year. You see, and the partner had done no real planning for him. The status quo was, I will meet with you once a year, I'll take in your tax information, and I'll prepare your tax return. The status quo is also, I'll meet with you once a year. Maybe we can save you a little bit of taxes, but I'm super busy, and then I'll prepare your tax return, right? The partner had done no real planning. Well, look, we sat down with the client. Him and his wife were in the meeting. They were devastated. And quite frankly, he was mad as hell. He was like, oh my gosh, I can't believe you did this to me, right? So right or wrong, he blamed us. And all I can remember feeling is that feeling in my stomach where I felt like I wanted to throw up, right? Have you ever felt that? Like, oh my gosh, he's blaming me. Is this really my fault? And I decided right there and then that I never, ever wanted to feel that way again. I just wanted to not feel like that, right? Have you ever had that feeling where you've just said, oh my gosh, I can never do this again? Well, I decided at that time that I was going to study actual proven masters of tax strategies. I knew there were guys out there that were writing articles, they were teaching classes, and they were working hard and proactively to save their clients money. So I also researched CPA firms that were proactive, not reactive. And quite frankly, there weren't that many. I wanted to go to work for one of those proactive firms after college, and I did. I decided at that time that I was going to commit to learning leading strategies that can help clients like you save the most they absolutely legally could in tax. I invested money. Sometimes I was a college student. It was money I didn't have, but I wanted to attend the most advanced trainings, not the free ones most CPAs attend, but the advanced ones that had the right strategies. And I committed to creating a system of tax savings with both short-term and long-term strategies. And after 2 decades, really what I've come up with is that, look, there's 5 pillars of tax savings that give you the absolute biggest benefit. The first one is often missed deductions. It's amazing how many deductions are actually missed. The IRS reports that over $1 billion in revenue comes into them that shouldn't every single year because of taxes. And the IRS is reporting this. Don't worry, they're not giving you the money back, right? Unless you ask for it. But they actually say Americans overpay their taxes by over $1 billion every year because of missed deductions. And a lot of times, those tax returns, they're prepared by tax preparers. Over 70% of them are. So tax preparers are also missing these deductions. The second pillar is retirement plan taxes. Look, other than our house in some cases, a lot of times our retirement plans are our biggest asset, right? And the tax strategies around those retirement plan taxes, there's a lot of different ways to look at those, and so we're going to investigate that today. Business structures for taxes. There's good ways to be structured for tax. There's good ways to be structured for liability protection, and there's bad ways. We're going to walk through each of the business structures and show you the best way for liability protection and for taxes to be structured. Then there's also this strategy of shifting income, which very few planners talk about. It's a matter of shifting income to lower tax brackets, and we're going to talk about that. And then there's some special strategies. Look, life is never the same for anybody, and sometimes we have those things that happen in life where it creates a huge tax burden on us because of whatever happened. There are actually special strategies out there that you can use and implement to take care of some of those special situations. So we're going to talk about those. But first, pillar number one, often missed deductions. One of the widespread often missed deductions is the home office deduction. You can take this whether you're self-employed, a business owner, or if you're an employee and do some work at home and need to work at home now and then. There's also a home office deduction that's available for you. It's limited a little bit more than it is for a business owner, but it's available for you. So what is the home office deduction? Well, it's based on square foot of your home. And so if you had a 2,000 square foot home and you had a 200 square foot office, right, basically your deductions are based on that 10%, that 200, 10% of your home. So most tax preparers avoid this deduction like the plague. And 20 years ago, when I first got started, I would have agreed with them, right? It was very highly audited by the IRS because of a case called Solomon. And you probably don't want to know that. I'm not going to quote a bunch of cases for you. But the Solomon case basically put a red flag on home office deductions because it was abused, okay? Now, 20 years later, the IRS actually gives you a simple method where they will just say, look, if you want to simplify this deduction, just take $5 a square foot based on the square foot of your home. And that's a safe deduction for you, right? So the IRS has done a complete 180, and now they're looking at, here's how we can help you take this deduction. But if you didn't want to take the $5 per square foot, you can actually take actual expenses. So you can take, in our scenario of 2,000 square feet and a 200 is business use, you could deduct 10% of your rent. You can take 10% of your mortgage interest. Sometimes you want that deduction there. Sometimes you want it on Schedule A where you can deduct it as well. But it's available for your home office deduction. Your insurance, you can deduct that. Your utilities. 10% of your utilities in our scenario could be deducted against your business income as a home office deduction. If you live in a place where they have a gardener, or if you live in a place where you have to shovel snow, all of those expenses, part of those can be used as your home office deduction. Ordinary repairs and maintenance of your home, whether it's specifically for your office or not, can be deducted. And then you can actually take depreciation on the value of your house and depreciate a percentage of that home over a period of time. That's also deductible. That's a deduction I usually don't recommend because when you sell your home, you have to what's called recapture that depreciation. But nonetheless, it's available for you if it works in your situation. Another often missed deduction is business travel. And again, if you have non-reimbursed employee, if you're an employee, expenses, these are also deductible, right? Non-reimbursed. But if you're in business for yourself, a lot of times people don't deduct their travel. So really, what is business? I say you should be deducting anything that looks, feels, or smells like business. That's your rule of thumb, right? Deduct it. I have so many people that come into my office and say, well, I have a whole bunch of deductions that I didn't take. The way I see it is if I ever get audited, I'll have all these receipts that I can take into the IRS and show them that I didn't deduct it, and maybe that will make my IRS audit go better. Yeah, that's foolish. Right? If it's deductible now, deduct it. You'll never get it otherwise. If it's not deductible now, don't deduct it, and you'll never have to worry about an IRS audit. if you structure things properly. So if it looks, feels, or smells like business, deduct it. What's that mean? Well, many of my clients are realtors, and I have never known a realtor that traveled anywhere in the world, quite frankly, but definitely nowhere in the US, where they haven't stopped or driven around a neighborhood, taken the for sale papers about homes, maybe talked to a realtor, figured out what the market was, figured out who was doing what kind of marketing. They're always working. They eat, breathe, sleep, drink real estate, right? And you're probably like that in your business, whatever niche it is in. So think about that. If it looks, feels, or smells like business, then it's deductible. If you're going to see Aunt Annie, okay, and you do some business while you're there, you might not be able to deduct the whole trip, but you can probably deduct part of it if you worked while you were there, if you did some of these things I talked about in the realtor example. Some of that business travel would be deductible. So what do we get to deduct? Well, definitely airfare, all the common things you would think, fuel or mileage. So if you're traveling in a vehicle, you can either take actual expenses or you can take a mileage deduction, a standard mileage rate that the IRS gives you. You can deduct your lodging, your meals. There's a 50% limitation on all business meals. You report 100%, the IRS will give you the 50% haircut. They're good about doing that. Transportation, if you take a train, if you use Uber, whatever kind of transportation, that's all a business travel deduction. And then there's foreign travel. People say, can I deduct my trip to Mexico or to the Cayman Islands or to whatever? The short answer is yes. And the reason it's asterisked here is because you have to be able to justify why you want to do that or why you need to do that. Why do I need to travel to Mexico? Well, quite frankly, it might be more economical than traveling to North Carolina, right? Depending on where you live. So if you can justify it not just because of something that's going on there like a seminar, but because it's less cost for the trip, whether it's an annual meeting or something like that, then you can deduct the foreign travel. Okay, let's talk about HSA plans. An HSA plan is a health savings account. Okay, these have gone through a very big transformation, and the IRS finally landed on this health savings account. They used to be MSAs and Archers and this and that and the other things you probably don't care about. But the health savings account, really, it's a way for you to spend pre-tax dollars for medical costs, and you get to deduct that on the front page of your 1040 with no limitation on the deduction. Okay, so let's talk about what does that really mean. You have to have a qualified health insurance plan. That means it must be HSA qualified. The easiest way to do that is to call your insurance provider and say, is my plan HSA qualified? If not, what's it look like if I switch to a HSA qualified plan? But at a minimum, if you're single and have single coverage, the deductible has to be at least $1,300. If you're a family, the deductible has to be at least $2,600. So how much can you contribute? Well, on a single plan, $3,400 per year. On a family plan, $6,750 a year. Okay, so what's that really mean? What's this get me? Well, let's use the family plan and do a little math. So if your tax rate between federal and state is 35%, contributing that $6,750 actually gives you $10,384.61 worth of buying power. Right? How does that work? Well, Uncle Sam's really giving you $3,634.61 because you'd have to make that $10,000, $10,384.61, then pay tax on it before you could spend the $6,750, right? You're getting it tax-free. You're paying those bills pre-tax. So that's kind of an HSA plan in a nutshell. They're super easy to set up, but you have to have the qualified insurance. Now, there's a lot of other often missed deductions. We're not going to go through all of them in detail, but you'd be surprised. State taxes, local taxes, property taxes, all that stuff is deductible. A lot of people miss it. Here's a big one. Education costs or education credits. There's 3 different education credits, and then there's one way to deduct your education costs, and you have to look at which is more beneficial. So when you deduct your costs, you actually reduce your income, and therefore you reduce the amount of your tax on that income. But when you have a credit, that's a dollar for dollar reduction in taxes. So if you had a tax liability of $6,000 and you had a $2,000 education credit, that comes right off dollar for dollar, and now your tax liability is $4,000. So that's the difference between deductions and credits. And when it comes to education, those are some often missed deductions and credits. If you're an employer and you hire certain people in certain jurisdictions, there's both state and federal job tax credits that a lot of CPAs miss. There's also energy credits for your home improvement. If you put in new appliances, or if you put in new energy efficient windows, solar is a big one, you can get actual credits, dollar for dollar credits against your income taxes. And there's so many more. You really need to sit down each and every year and figure out what happened in my life and how can I deduct this. So now let's talk about retirement plan tax savings. There's a lot of misinformation out there. There's a lot of information around retirement, which is one of our biggest assets that we have. That misinformation has been common belief for a long time. We're going to talk about some of that. So there's 1,000 different ways, right, to invest your money. There's mutual funds. There's this mutual fund, that mutual fund. There's individual stocks. There's individual bonds. There's tax-free bonds. There's ETFs, all these. That's not what we're talking about today. What we're going to talk about is 3 ways to invest your money related to taxes. And it really comes down to this. There's 3 buckets you can put your money in. One is called tax today or tax always. There's tax tomorrow, or what I call tax later. And then there's tax never, which we know that's not quite true, right? One thing we know about life is death and taxes, okay? So it's not quite true tax never, but it's basically true. Let me explain this with an analogy. So there was a farmer, his name was Farmer Brown, and he had 3 sons. And his neighbor was Jim Jones, Farmer Jones, and he had 2 sons, right? And so he was living in this world where Uncle Sam, the IRS, would come and they would tax his seed, and then he would plant his seed. And then when he had a bountiful harvest, Uncle Sam would come and take a piece of that harvest, right? He was in that tax today world, tax always world. Everything he did was being taxed. And so then he said, look, boys, he had 3 sons. He called them in and he said, look, I'm getting taxed to death. There's nothing left for you. There's no more room on the farm. You must go out and be fruitful in your own ways. And so his 3 sons went out. And his oldest son went and found a farm, and he did things just like his dad did. And soon he was being taxed on his seed, and taxed on his harvest, and taxed and taxed and taxed and taxed. Every time he had a windfall, Uncle Sam came in and took his share. He was barely getting by, but he could feed himself, but he couldn't feed his family because of the taxes. The second son decided, hey, the Jones brothers, who also are out on their own now, are going over here with this big group of people. What are they doing? So they went over there into tax later or tax tomorrow land. And what happened there is the government would come in, and as they gathered their seeds, they would say, look, the seeds you have, you keep all of it. You keep all of those seeds. I'm not going to tax your seeds. When you grow a bountiful harvest, I will come and tax your harvest. So they weren't taxing them now, they were taxing them later. Okay? And so they thought, hey, this is a pretty good deal. I'm not paying tax all the time like my dad was. And the Joneses are all over here. So if I'm going to keep up with the Joneses, I should probably be right here where I am in the tax tomorrow bucket. Okay? Then there was the very youngest son, and he said, all these people are going over there with the Joneses. There's just a small group of people going this way. I'm going to go with them. And they went to that Tax Never farm. And what happened there, and I said, Tax Never is not quite true, but they got a pile of seeds in their hands that their father had given them, and they went over there, and the government was standing there waiting. And so they were standing there waiting, said, look, I'm just going to tax a portion of your seed, so why don't you give me some of that seed that you have, and then whatever you harvest is all yours to keep. And the youngest son thought, wow, there's not very many people doing this. There's a lot of people over there, but this sounds pretty good because I know that my seeds will multiply. I know when I put seeds in the ground, they will multiply. So I'm going to stick with this strategy. And so he gave some of his seed to the government, and then the rest of his seed he went out, and it was never taxed again. His harvest was never taxed again. So let's talk about this, right? What does that look like for you? Tax today, tax always. What is that? Well, it's your savings account. It's your brokerage account that's in your own name. It might be dividend stocks. So think about that. In your savings account, you pay tax on this money. Then you put it in your savings account, and then it makes interest. And every single year, Uncle Sam comes and takes some of that interest. He had already taken a piece before you put it in there, and now he's taxing your interest, right? Your brokerage account that's in your own name, he's taxing that. Is this right or wrong? No, it's not. There's some advantages to having that, right? What would you want in that tax always bucket? The advantage is all that money's super accessible, right? You can go down to the bank and take it out. The disadvantage is it's taxed and taxed and taxed and taxed and taxed, okay? So it has its place, but it's what most people do. That's the thing you want to think about. This is what most people do. And then some people say, well, for my retirement, I'm going to do something different. So we go back to the bucket. You can see that the tax today bucket, that's a leaky bucket. And then we go to tax tomorrow or tax later. It's also a leaky bucket. Why? Let's talk about it. What are these things? Our tax later bucket, Uncle Sam is saying, hey, I'm going to give you the seeds for free. You don't have to pay tax on those. But I'm going to come back and I'm going to tax it when you harvest. So when you put money into a traditional IRA, you get a tax deduction for it now, and later on when it grows, he's going to come and tax 100% of what you grow, right? And he's going to take his piece of that 100%. Another example is a simple IRA plan for business owners. A SEP IRA, which we're going to talk about in detail. All of these traditional type retirement investments, your 401k, your solo 401k, if you're a solo business owner. Pension plans fall under this tax tomorrow bucket. Defined benefit plans, which can save you a lot of tax. You can really put a lot of money into a defined benefit plan. It's going to get taxed later as well. Annuities are this way. You put after-tax dollars in, you pay tax on the growth, okay? And real estate. This will shock some of you because real estate's an awesome investment. I love real estate. My clients love real estate. You may or may not love real estate, but real estate is still in the tax later bucket because you get a lot of tax deductions now. And so you might have a positive cash flow and you're not paying tax. You get some tax breaks now, right? But sooner or later those go away. And then when you sell the property, you still have to pay tax on that. You can use this section 1031 to avoid that, but that's just, again, pushing the tax down out to a later date. So real estate really falls in the tax later bucket. So let's have some fun with math, okay? This is the whole tax tomorrow, tax later strategy. And this is based on a client who walked into my office a couple of years ago. His CPA had passed away. His name's Jack. And his CPA had passed away, and he said, Vern, I want to look at taking some money out of my SEP plan. I'm ready to retire. And he was 62. That's an early retirement, right? He was 62. He said, I want to take money out. I've contributed to this thing forever. I just want to retire. So this is based on his story. It's not his story completely, okay? So let's just say you contribute $50,000 a year to a SEP IRA. The maximum right now is $54,000, but I'm going to use $50,000 because it keeps the math simple, okay? So we're going to do this for 25 years. And let's just say we make 7% average annual return. So if we contribute $50,000 for 25 years and we make 7%, how much do we have for retirement? $3,162,454.42. Now, hey, look, that's a pretty nice chunk of change, right? That's a nice retirement. I think you would agree. The question is how long will it last? How long does that $3 million last? Well, let's just assume that during our retirement years, we continue to earn 7% annual return on the money, right? And we want to net $200,000 a year, and that's exactly what Jack wanted. How much do we have to withdraw annually in order to get to our $200,000? Well, we need to withdraw $300,000 a year to net $200,000. So now, how long do you think the money will last? 14.9 years. Wow, that's it, right? 14.9 years, 179 months. That's a completely different retirement plan. And that's exactly the situation that Jack was talking about. He's like, well, I should be able to live out my years. You see, when he started putting money away 25 years before that, life expectancies were a lot lower. You didn't think you would live as long. Now the challenge is people are outliving their money every single day. So that plan that he thought would work for him, now he wasn't quite so sure. He had to change his retirement significantly if he was going to not outlive his money. So why did that happen? Well, there's one reason, and it's taxes. You see, that's the myth. Everybody says, hey, put this money away. When you pull it out, you'll be in a lower tax bracket, right? You're going to be in a lower tax bracket at retirement. That's rarely the case. I mean, let's look at our country. We've got $20 trillion in debt. We have a non-balanced budget. It's like we're enabling a spending addict, right? So do you think taxes are going to go up in the future, or do you think taxes are going to go down, right? You see, most people don't realize, but the highest tax rate in the U.S. ever has been 95%. 95%. That's huge. So do you think taxes are going to go up, or do you think taxes are going to go down? So let's talk about the tax never bucket, right? You can see it's not a leaky bucket, but let's talk about what does tax never actually mean for you? Well, the first one is like a Roth IRA. And some of you are probably saying, oh yeah, I've heard of a Roth, but I make too much money to contribute to a Roth IRA. Well, and others are saying, well, a Roth is great, but I can only contribute $5,500 a year. I'm not going to retire on $5,500 a year. If you're over 50, it's $6,500 a year. You're still not going to be able to retire on it, right? But if you do make too much money, there's actually a backdoor strategy to your Roth. You can make a deductible or non-deductible traditional IRA payment despite your income, and then you can roll that once a year into a Roth IRA. Real estate investors love Roth IRAs because even though you can put only $5,500 in there, there's strategies around a Roth where you can grow those very, very quickly using real estate. And you can grow them very quickly, and you grow them tax-free. Tax never, right? So there's also a Roth 401k, which is, again, this whole tax never thing is Uncle Sam is saying, I'm going to tax your seed, but whatever your harvest grows into is yours to keep. And then there's something called 7702 plans. Well, a 7702 plan, the reason I like them so much is because there's no income limitation. Doesn't matter how much money you make or how little you make, or if that income is self-employment income or if that income is wage income. There's no income limitation. There's really no contribution limit. I have clients that are putting $200,000 a year away into a 7702 plan, and I have clients who are putting $50,000 into a 7702 plan. You could do less, you could do more. The contribution limit is not based on your income, and it's not based on IRS regulations. So this money grows tax-free, just like we've been talking about in the Tax Never bucket. You get to withdraw all your money tax-free. There's no age restriction, so you can pull your money out before you're 59 and a half, unlike if you're in an IRA or a Roth IRA, you need to wait till you're 59 and a half to pull your retirement money out. Plus, you have easy access to your funds. You can get your funds at any time, right, where retirement assets are tied up. For example, if you wanted to fund college for a child, you could use this plan to do that. You could not use your Roth IRA or your traditional IRA retirement type plans, right? You'd have to pay the tax if it was traditional, and usually a penalty. So there's easy access to your funds. You can get to it at any time. And then on death, you also have tax-free distribution on death. How does that compare? Well, if you have a traditional IRA or a traditional SEP IRA or any of those in the tax later bucket, and you pass away, if the beneficiary stuff is not set up properly, you could pay tax on the full amount of that in that year. For example, an attorney I work with had a client, and she inherited her mother's IRA, $1 million. That's rounded, okay? $1 million. And they cut her a check. She got $1 million, had no idea she needed to pay tax on that money. The tax bill was $570,000, right? That's huge. So she had to pay tax on that all in 1 year because it wasn't structured properly. In a 7702 plan, that's not the case. So it's like, hey, what the heck is a 7702 plan? It's cash value life insurance, but it's a specific kind of cash value life insurance. See, usually when you say life insurance, people go, right? Because they see the sleazy little salesman. And here's what happens. In life insurance, most life insurance people talk about the death benefit. How much death benefit can I sell you? How much death benefit do you need, right? And that's what they sell you. That's not what this is about. This is life insurance to be used during your lifetime. You want to use it all up, right? You don't want to leave any of it left, right? So think about this. If your insurance guy has always talked to you about what kind of death benefit you need and what you need to buy, they get paid on that. I've known hundreds of life insurance people, salesmen, and I'm not saying anything against them. They do great service. I've known about 2 that know how 7702 plans work and how they should work. Because 7702 is the tax code section that governs how much money can I put away and get all these tax advantages for the least amount of death benefit. I said the least amount of death benefit. See, that's the ratio you want. You don't want a lot of death benefit and put a little money away. You want to put a lot of money away and have a very small death benefit because you're in it for these tax savings. Okay? That's the complete different plan. So let's have some fun with math, right? On the Tax Never bucket. So these have to be properly structured. It's very, very simple. But as I said, I've known hundreds of life insurance guys, and I know 2 that actually get this part right. So I don't do insurance. Our firm doesn't do insurance. I just want you to show you how this works. So we're going to contribute $35,000 a year. And you might be saying, okay, why not 50? Well, remember, Uncle Sam's taxing our seed. So we have to make $50,000, give 15 to Uncle Sam and put $35,000 away. Right now, that's not sounding like it's as good of a deal as the other way around, right? Stay with me. So we're going to do this for 25 years. We're comparing this to that SEP IRA math, right? And we're going to say, okay, we made 7% average annual return on this investment. So the question is how much do you have for retirement? $35,000 a year away for 25 years, earn 7% return. How much do we have for retirement? I know already in your head you're thinking it's less. It is. It's 2.362711.80, right? $2.3 million. Now, I think you'd agree, though, that that's a pretty nice chunk of change, but it's not nearly as much as the SEP IRA. So, how long will it last? That's the real question, right? Because in the SEP IRA, it only lasted 14.9 years, and it was over $3 million. This is just over $2 million. How long is it going to last? That's the question. Well, let's continue to say we earn 7%, just like in our other scenario, and we want to pull out $200,000 a year. How much do you need to take out every year? Well, you only need to take out $200,000 a year. Why? Because it's tax-free. Yeah, it's tax-free. So, how long's the money going to last? Well, because of the way the 7702 plan's structured, right? You don't pay tax on the withdrawals, and the way it's structured internally with the life insurance contract is very different. So warning, what I'm about to tell you is very counterintuitive. You've probably never heard it before. Your money lasts for 493 months. Wow, right? That's over 41 years. A smaller amount of money, but you don't pay tax on it. You don't have to pull as much out. Lasts for 41 years. So now let's actually look at the effect of the taxes on the SEP IRA, which is what everybody tells us to do. We quote unquote saved $375,000, right, by putting money into a SEP IRA. We saved $15,000 a year in taxes for 25 years. There's no argument there. But what did it really cost us? See, the total tax cost was $1,490,000. That's $100,000 a year for 14.9 years. See, Uncle Sam's willing to wait. That's why it sounds like a good deal. You just keep all those seeds. I'll give you your seeds for free, but I'm going to tax your harvest. Okay? It cost 1.4, almost $1.5 million. So, what's the tax cost of a properly structured 7702 plan? Well, it cost us, in real dollars, $375,000, right? We made $50,000 a year, paid tax of $15,000, and we only had $35,000 left to put into our 7702. And we did that for 25 years. That's $375,000 over that period. But what were our tax savings? We got 41 years of tax-free retirement. 41 years. $200,000 a year. That's over $8 million in tax-free retirement. So which would you rather have? You see, that's the difference. That's the difference in planning your taxes for 1 year versus your entire lifetime. What's your strategy? Is your strategy to save that little bit every single year? Or is your strategy to have something that's going to take care of you and your family for a lifetime? Okay, let's talk about the third pillar, business structures for taxes. So, the ways you can structure your business for taxes, there's sole proprietorship, which is a Schedule C on your individual tax return. There's a limited liability company, or LLC. We're going to talk about those. You can set up as an S corporation. You could set up as a C corporation. And you can set up as a limited partnership if there's more than one owner. It's very similar to a limited liability company when it comes to asset protection and taxation. So we're going to talk about the top four. So, what do most people do? And if you're in this boat, I am not being mean to you at all, okay? If you're where you are, it's where you are. But most people do a sole proprietorship. Why? Because it's easy. And why is it easy? Uncle Sam makes it easy to be a sole proprietorship because you pay the absolute highest taxes out there. Plus you have zero liability protection, right? And What you probably don't know is that Schedule C sole proprietorships are the highest audited form by the IRS. More audits are conducted on Schedule Cs than all the others combined. Okay? So let's walk through the tax savings part. What does this look like? So if you're in a sole proprietorship and you make $300,000 worth of income, and let's say this is net income. So maybe you grossed $400,000, you had $100,000 in expenses, and then you netted $300,000. So the self-employment tax on $300,000 as a sole proprietor is $24,473. And then let's say we have $22,000 worth of deductions, just so we can keep all these scenarios the same. We're going to say standard deduction and some exemptions, $22,000, right? And they're all going to be the same throughout all of our illustrations. So that gives us a taxable income of $265,764, right? Because we get a deduction of part of our self-employment tax. So our income tax is $65,264. And we add the $24,473 of self-employment tax to that, and we are paying $89,737 of federal taxes. Now, if you live in a tax that only has a 5% state tax, you add another $15,000 on that, right? That's huge. Over $100,000, over a third of your bottom line income is going to Uncle Sam. Right? So let's talk about a limited liability company or an LLC, because the most common thing I hear is I'm going to set up an LLC because it's going to save me taxes. Or my friend Joe said, hey, he set up an LLC and he doesn't pay anything in tax. Right? That's my favorite. So what a limited liability company really does is gives you liability protection. Hands down, depending on the state you live in, the liability protection of an LLC is usually the best. Again, that depends on what state you live in. But you get no tax savings with an LLC unless you elect how you want to be taxed. You see, limited liability companies started in the state of Wyoming in 1978, okay? And even though that's a long time ago, for some, that's a long time ago, but the IRS still doesn't know how to tax them. They still didn't have a definitive way to tax a limited liability company. So what they did is they basically said, look, if you don't choose how you want to be taxed, we're going to tax you in the worst possible way. So if it's a one-owner LLC, we're going to tax you as a sole proprietor. And if it's a more than one owner, we're going to tax you as a partnership. The worst ways to be taxed. Okay, but you can choose to be taxed in any other fashion. You just have to do a little more work. Okay, so the limited liability company from a tax perspective is very flexible. But if you want tax savings, you need to elect within 75 days of forming it to be taxed as an S Corp or a C Corp. So from a tax perspective, we're just going to talk about the other two because the LLC can be any of them, okay? But you have to elect that tax treatment. That's very important. So let's talk about an S Corporation. Now, S Corporations are wonderful. It's what a lot of people do. You can save a lot of self-employment taxes, okay? And you do have liability protection, whether you're an LLC taxed as an S corporation or you just set up a corporation and you elect S status. It lost some of its tax advantages in 1986, but one of the nice things is I think the current administration is going to bring back some of the tax advantages that we'd like to see with S corps. So it's called a flow-through entity. And what that means is that income that the S corp generates flows through to the owner's personal tax return. So the owners pay the tax on the income. The S corp pays no federal taxes, but some states have like a franchise tax or a business tax, so some states will actually tax your S corp income. But the S corp pays no federal tax. So let's look at how this looks. Same $300,000 worth of income. I have to pay you a reasonable wage. What's reasonable? Well, that's all the tax code says is a reasonable wage. And I've had clients who said $3,000 a year is reasonable, and I've had clients who said $50,000 a year is reasonable, right? Some say more, whatever it is. I think $50,000 in this scenario is a good number, right? So we pay you a $50,000 wage. That means the net from your S Corp is $250,000. Now we're still paying the same amount of tax on the same amount of income. We're just making $50,000 a wage and $250,000 earnings from your S Corp. So we take our $22,000 off and we're at taxable income of $278,000. The income tax on that is $69,589. The self-employment tax, which is the payroll taxes we pay on the $50,000, is only $7,650. That means our total tax is $77,239. That's a tax savings of $12,498, right? That's huge. So I had a client a couple of years ago from Pennsylvania, and she called me up, and she was a realtor, and she was a little disorganized. I'm going to say her name, Diane. That's not her real name, but I think you understand. We want to keep things confidential. So she called me up, and I said, you need to set up an S Corp. It will save you a lot of money. And she said, okay, maybe we'll talk about that next year, right? And the next year came along, and she realized what she owed in taxes. And I said, I told you, you really need to set up an S corporation. She said, okay, you convinced me, let's set it up. So we set up the S corporation. The next year when we did her taxes, I did a comparison between what she would have paid had she still been a Schedule C sole proprietor and her S Corp. And she saved over $17,000 between federal and state. That's a lot of money. S corporations save you a lot of money. You get to control how much you pay in self-employment tax. So let's talk about C Corps. The benefits of a C Corp are you got liability protection, right? That's one of the things. We're trying to protect our assets and get tax savings. But a C corporation pays its own tax. It's not a flow-through entity, so we'll talk about that. And there's more, and some people say better deductions. So it pays its own tax. So on the first $50,000 worth of income, the tax rate is 15%. On the next $25,000 worth of income from $50,000 to $75,000, that's taxed at 25%. And then on the next $25,000 worth of income from $75,000 to $100,000, that's taxed at 34%. Okay? And then it goes up from there. The highest corporate rate is 39%. So it pays its own tax. So how does that work? I use a C corporation in conjunction with an S corporation. I usually don't like to use them alone, depending on the owner of the small business. So what we're going to do is we're going to walk through an illustration where we still have the same $300,000 worth of income, but $200,000 of that income is going to flow through our S Corp, and $100,000 is going to flow through our C Corp. So we pay a wage out of each of those of $25,000 each, right? So we're still paying $50,000 in wages. And then you can see on our S Corp side, we're going to net $175,000. And so what gets reported on our income tax return is going to be $197,000 by the time we take the other deductions we talked about. The income tax on that is $44,695. The self-employment tax on all $50,000 worth of wages is $7,650. So our personal taxes basically are $52,345. And then over on the C Corp, that $100,000, we take away the $25,000 that we reported on our personal return, we have $75,000 net. So our taxable income in the C Corp is $75,000. The tax on that is $13,750. That means total tax is $66,000, okay? So wow. Hey, that's $23,000 worth of tax savings. Over $23,000, right? So that's a pretty good deal. So you can see now both how that works. You start combining some of these strategies and they start saving you more money in tax. But here's the even better news. The current administration has proposed a top rate of 15%. That's top rate. No more of that 25, 34, or 39, right? Top rate of 50% on all corporate income. all corporate income, yeah, that means C Corps and S Corps, if the tax changes go through, may only pay 15% on all the income under these proposed tax cuts. That would be virtually huge for you. That would be so huge for our economy and definitely huge for you as a small business owner. So let's talk about the deductions. So a medical deduction on your personal return is limited by 10% of your adjusted gross income. And all that really means is if you make $300,000, the first $30,000 of your medical expenses are wiped out. You don't get to take those. In a C corporation, 100% of the medical deductions are deductible. And then there's Section 127, which is education expenses. You can pay higher education costs for your employees, which may be you, which may be your kids, of up to $5,250 per year, and that gets fully deducted on a C corporation. There's a Section 125 cafeteria plan. What a cafeteria plan is, it's like the HSA we talked about earlier. You get to use pre-tax dollars to pay for things like childcare. That's a big one inside of a cafeteria plan. And then one of the other deductions is state taxes. And one of the reasons that might be better is because you can choose what state your C Corp, depending on your situation, is operating out of. So now let's talk about the fourth pillar, income shifting. What does that really mean? Well, you can shift income in really two ways. You can shift to a lower tax rate, or you can shift to a different tax period. So what's a lower tax rate? Well, currently it's like shifting income from your S Corp to your C Corp, right? Moving that income into a lower tax bracket. Another one is to pay your kids. How often have you used your kids in your business? Do you use your kids in your business? Should you be using your kids in your business? Should you be paying them a wage so they can pay tax on income at a lower level than what you're paying it at? It's a definite strategy that works very, very well when implemented properly and when it's appropriate. And then there's income shifting into a different tax period. So we'll use the C corporation. Everyone pays taxes, generally speaking, from January 1st to December 31st. That's the tax period. That's your tax year. Well, a C corporation can have what's called a fiscal year end. And a fiscal year end might end, say, in October 31st. And so the year starts November 1st and goes through October 31st. Or it might have a different month. Whatever is, if you move income into that at the right time, the taxes on that income could be deferred for up to 14 months before you actually pay tax on the income you would have been paying on your personal return. So that's income shifting as it comes to using a fiscal year end. And then we have the fifth pillar, which is special strategies. You see, a lot of times there's things in life that happen that are special, and sometimes they cause a significant tax burden for us. Some of those might be one-time sales. So a lot of times if you have real estate and you want to sell real estate, there's what's called a tax-free exchange or a like-kind exchange or a Section 1031 exchange. That's all the same thing, where you sell property A, but you have to invest everything that you sold it for into property B, right? But what happens, that's a great tax strategy, by the way, but again, what you're doing is you're pushing those taxes further down the road. What happens when you don't want to buy real estate anymore? What's that look like? Most tax advisors tells you it looks like you're going to pay a lot of tax, right? There are strategies out there that we use that can get that sale virtually tax-free without investing in real estate again. You have 100% use of your cash. So there's strategies like that. If you sell a business, a client came to me a couple of years ago and they had just sold their business. He says, the partners and I calculate that we're each going to owe about $1.2 million in tax on the sale of our entity. Well, that's a lot of money. And I said, well, I wish you would have come to me before you sold the business because I could have saved you more, but right now I can save you just over 50% of your tax if we implement this strategy. And so we looked at it, made sure it fit for them, made sure it worked for them, and that strategy saved him on the sale of his business over $600,000 in tax. That was a one-time sale. His partner still paid one too because they didn't want to listen. But he paid over $600,000 less than that. And sometimes stocks as well, right? You have one-time sale of stocks. Maybe you've had it, maybe you'd inherited it, maybe it was a gift from your grandparents, whatever it is, and you sell a bunch of stock. There's strategies for those one-time sales. And then there's also strategies for high annual income earners, okay, whether that's businesses or wages. Most of the time, if you're a W-2 employee, and mortgage brokers fall into this category a lot, where they can make a high income, but statutorily, that means by law, they have to be paid by a W-2 as an employee. Usually there's very little most people can do for them. There are strategies that we can put together that can save them a lot of money in taxes if they're high income, high business income or high wages. And then a high one-time income. Had a client a few years ago, and what happened is the owners of his company, and he was a key employee, sold the company. And they made a lot of money, and they gave him a large bonus. And that large bonus jacked his income really high into the highest tax brackets for a lot of his income for that year. And there's strategies that you can use to alleviate that. Those are life-changing type tax strategies that help in those certain instances where you save a lot of tax all at once. See, these special strategies can save you 50 to 99% of the tax. That's huge. 50 to 99% of the tax if implemented properly. So the reality is it's about what your tax strategies are. What are your tax strategies? You see, these are just a few of the tools that are in the toolbox. What you need is a strategy that works for you and that works for your business. You need a strategy that's flexible, that gives you freedom, that's flexible for your life. That's what you need. So look, you're at your computer, you're watching this training. You've heard how these various strategies can help you, and you know that using tactical tax strategies can save you boatloads of tax. So why not let us help you create your plan? Why don't you let us help you create a plan that's specifically designed to help you save the most tax, that's specifically designed to be flexible for your life changes, that's designed to be completely tailored to your needs and your goals, that's designed to keep you on the right path, that's designed to save you a bunch of taxes. So if you want to save a bunch of taxes and you want to keep more of your money, if you want to create a tax-free retirement, if you want to have certainty, if you want to take care of your family, and you want to feel confident with your financial future, then this is specifically for you. Here's how we'll do it. We get on the phone or Skype together. We learn more about you. We learn more about your business. We learn more about your goals, your retirement, and your family. We learn about where you are now and where you want to be. Then we create a strategy that works for you. So here's what that'll do for you. That strategy, you're going to know exactly what you need to do to save the very most tax for your personal situation. You're going to know the best tools to help you achieve your goals. You're going to know exactly how to implement your plan. You're going to feel certain that you can achieve your financial goals with that plan. And you're going to know the best retirement plans for you to fund. You're going to know the best investment strategies to help you achieve your goals. And so then you think, well, what's all this cost, right? This sounds great, but what's the price? Let me ask you a question. What would it be worth to you if we showed you how to save $50,000 this year? Would that be worth $5,000? Would it be worth $10,000? If every time I gave you $50,000, you had to give me $10,000 back, how often would you want to do that? Every day? Every hour? What if we only showed you how to save $10,000 this year? Is that worth $1,000? Is that worth $2,000? Look, it's way better than that. Would you invest $500 to have a plan personally designed for you that saves you $5,000 to $50,000 a year in tax? If we only saved you $5,000 in taxes, that's 100 or 1,000% return on investment, right? 1,000%. Where do you get that? You don't get that in the stock market. You don't get that in real estate. And it's 100% guaranteed. So here's what to do next. Go to save50kintax.com/strategy. Save50kintax.com/strategy. You choose your payment method, right? Then Carol, she's my assistant. She's been with me for over 17 years. She's going to call you within 2 business days to set up a time to talk. We're going to email you with a secure way for you to share whatever information you can give us to help you create your plan. And then we're going to review all of this information. Then we're going to get on the phone or Skype with you, and we're going to learn more about your business. We're going to learn more about you and your goals and your retirement and your family. We're going to learn about where you are now, where you want to be. Then we create your personal tax strategy. So look, if you want to save tax, if you want to keep more of your money, if you want to create that tax-free retirement, if you want to have that certainty, if you want to take care of your family, if you want to feel confident with your financial future, then go to save50kintax.com/strategy. But look, it still gets better than that, right? I told you it was the boldest guarantee ever. So, the boldest guarantee. If by the end of our time you decide that you didn't get any value, you let me know and I'll give you a full refund. Look, no questions asked. You can still keep the plan I gave you. How's that for fair, right? You decide if you receive value. Your word is gold. I don't want your money if we can't help you, but it still gets even better. When you do have your plan and you do love it, one of 3 things will happen. First, you'll love your plan and you decide to have your CPA implement it with you. I'm going to wish you all the best. If you have questions, your CPA has questions, we're going to answer those for you, right? Sometimes we decide we're not a good fit, right? This doesn't happen very often, but once in a while, one of those tax protesters or tax resistors or fraudulent filers find their way in, right? We decide we're not a good fit and we go on down the road. Or 3, you're going to love the plan and you're going to want us to implement it with you, right? And when you become a client, then we become your financial quarterback. See, we implement the strategies, we prepare all your tax forms, we handle any bookkeeping if that's needed. We consult regularly to stay on track. We want to stay on track with the plan to save you the most, not just this year, but for a lifetime. So when you become a client, we do all of that so you can focus on your income and your family. That's what's important. But that's the good news, right? So the bad news is we can only accept 22 new tax strategy clients. We can't do this for everybody. We just don't have the volume, and I don't want to go fast. I want to take my time with you and create a perfect strategy for you. So if you're ready for your personal strategy with the boldest guarantee ever, so there's no risk for you, then go to save50kintax.com/strategy. I'll look forward to talking to you during your strategy session.